Welcome to the Real Estate of Things podcast. I'm your host, Dalton Elliott. I'm joined today by Gary Beasley, the CEO of Roofstock. Gary, thank you so much for joining.
Great to be here, Dalton. How are you?
I am well. Thank you. Thank you. I think you and I connected at IMN East, kind of the big SFR conference in the space. Was it a month or two ago at this point? Somewhere in there.
Time is ephemeral these days. I think it was about 6 weeks maybe ago. Yeah.
That sounds about right. Yeah, it is. What is time but a social construct these days, especially? So you and I were able to catch up a little bit last week. Really enjoyed our chat, and we have a packed agenda today. First, I want to learn a little more about you and Roofstock. Roofstock is a behemoth in the space, and I was kind of impressed, would be the best word to attach to it, that Roofstock was founded in 2015. Is that right?
2015. That's right.
Yeah, it's a crazy meteoric rise. So you're going to have to give us the secret sauce there. And then we'll dive into everything from investor habits, retail investors and homeowners versus institutions, other topics like affordable housing and the flight of capital from coastal markets. We have a jam-packed agenda. But like I said, first, tell me a little bit about yourself, about Roofstock.
Yeah, well, I start with myself, I guess, because it gives you a little bit of an idea of my background, and it's informed the way that I've sort of thought about building Roofstock. So I actually grew up in a real estate family. My dad had his own very small commercial brokerage firm in a small town in Indiana, Northwest Indiana, and went to college at Northwestern, which was only an hour and a half away from where I lived, but it was a world away. And I would say my eyes sort of got opened at Northwestern to lots of things. And then I went to business school at Stanford, and that was like my full awakening of entrepreneurship and all the art of the possible. And I've always had a sort of a love for real estate, but a passion for innovation and looking for better ways to do things. And real estate's historically been one of those industries where it's residential real estate is arguably the biggest asset class in the country when you look at the 25 trillion of assets that sit in houses, but just real estate in general, massive asset class, and has historically been slow to innovate. And so I've spent much of my career at this kind of intersection of real estate and technology and looking for ways to improve things, looking to try to kind of skate where the puck's going and take advantage of having the wind at your back a little bit on some of these macro trends, and we could talk about that. But spent some of my time in my earlier days in the resort business, kind of after the RTC crisis, which was a while back, but that was a historic time to be able to acquire assets and redevelop them and restore them. And spent some time in the early days. This is actually my third real estate startup. Roofstock is. My first one was Zip Realty, which was one of the first online residential brokerages. It's very similar to a Redfin today. It predates Redfin a little bit. We took that company public in 2004, and I was the CFO of that business. And the next real estate startup was Waypoint Homes, we were one of the early kind of pioneers in single family rentals. My partners, Doug Bryan and Colin Wheel from there, they were actually the founders of Waypoint. I joined them soon after the founding, but we built that together really starting in about 2011 and attracted some of the first institutional capital to the space and built up quite a large portfolio of rental homes, figured out how to build a scalable model, built some tech around it, and ended up taking that public as a REIT. And so I took that public as the co-CEO along with Doug in 2014 as a REIT. And so that kind of leads me up to Roofstock. And I left, actually April Fool's Day of 2015 was when I left Starwood Waypoint. And a lot of people thought I was kidding because, the CEO sends out this note, I'm leaving. Actually, because it was April Fool's Day, I did say I was leaving to start GaryNation.com, true story, to bring back the name of Gary and restore it to its luster. And so that part was not true, but the part about my leaving that day was true. And so left then to start Roofstock with my co-founders, Gregor Watson and Rich Ford. And within about 6 weeks, we had raised our Series A. We raised a $6.25 million Series A in late May, and we were off to the races, hired a team and got going.
That's
And
crazy. So good.
No, I was just gonna say. I mean, it's been 6 years, but and it's gone incredibly fast, and the market has evolved so quickly. I mean, we knew when we were starting Roofstock. Maybe I'll just explain what Roofstock is for those who don't know. We're a marketplace for single family rental homes. So imagine you could come to our site as an owner or a buyer or seller of a rental home, and we've got products and services for you. So think about us kind of as the rails, if you will, for investors who want to participate in this asset class. So we have a robust marketplace where you can buy and sell individual homes that have tenants in them already or are tenant ready. You could buy them sight unseen from anywhere in the world through our site in more of an e-commerce experience. So we break down a lot of the barriers to real estate investing, bring a lot of the tools that we developed from our institutional days and have figured out how to sort of productize it for the average investor. So you could be on a level playing field with a lot of the institutions out there that are looking at the same houses. And then we provide that last mile of servicing by offering property management through partners, and more recently through our acquisition of Great Jones. Now we have our own retail property management as well. Think about us as kind of a soup to nuts experience, fully vertically integrated now. If you want to optimize your ownership experience or buy and sell, you come to Roofstock. So think about it as a sort of a managed marketplace. And we have gotten some decent traction over the years. We crossed over about 3 billion of transaction volume early this year. But to give you an idea of how the industry has progressed, so now we'll probably do about 2 billion of transactions just this year. So the momentum has built such that there's so much interest in housing, U.S. housing, from investors, large and small, that the wheels are rattling. We're trying to keep up with that. But we've built the business for this opportunity to really now we're the place where we're really set to scale it.
Yeah, the Roofstock flywheel is in motion. It really is a beautiful platform. Huge testament to you and the crew. One thing you touched on is institutional investors, and at the conference you and I were at 6 weeks ago, that was a big topic of discussion. There was almost an air of us versus them in a lot of the panels and side conversations, right? Of us, even if, I'm an investor who has hundreds of units, even sizable investors, a little bit of talk and murmur, and potential concern about the normal retail investor in the mom and pop type operation versus institutional investors. What's your take on, is this an actual battle that's set up? Are we in the middle of it? Is it something that's just kind of headline and overblown? What's with it?
Well, it's a complex question, and as you can imagine, I think the answer's got to be somewhat nuanced. There's not a right or wrong, and I will say that I make it even more complicated. So you've got the small investor against the large investor, and then you've got all investors against homeowners competing for the same houses, and that's a whole nother conversation. Are investors in general crowding out homeowners? And that's we could address that too. But I would say a David and Goliath story is always interesting. It's always kind of fun for the press to sort of dig into those topics. I actually think that individual investors oftentimes have an advantage over institutional investors because they do have that local knowledge. And the advantage that they have is they've got these local relationships. They could perhaps be a little bit scrappier and more entrepreneurial, assemble portfolios that could then be sold to these bigger institutions, because the institutions would love it if you could bring them a portfolio of 5, 10, 20 homes that you've pulled together. And it's efficient for them to make those acquisitions. So what's happening is those investors they're buying things themselves, but they're very much open to other acquisition channels. So I think if the smaller investors view the larger investors as potential partners, capital partners, and that could buy their portfolios at very nice prices, their cost of capital tends to be lower oftentimes, and they're willing to pay a nice premium for homes that have been aggregated for them by some of these smaller entrepreneurs. So I would say smaller investors, it's competitive out there for sure, buying houses no matter who you are, but take advantage of the local knowledge that you have, and try to view that competition as more of a partner who could help be there on the offtake for you. And then in terms of the retail owners versus the investors, I would say that, in my opinion, that story has been perhaps a bit exaggerated. The amount of institutional capital that's coming in really is a drop in the bucket relative to the overall housing market. If you just look at the numbers, there's about, call it 5.5 or 6 million transactions a year of homes that are purchased. And all of the institutions together collectively, if you look at maybe the top 20 of them, own fewer than 300,000 homes collectively. So if you look at that, so out of maybe there's 20 million rental homes in the country, out of the 90 or so million homes, only about 300,000 are owned by the big institutions. And when you look at the number of homes that are being purchased on a monthly basis by investors purchase about, call it 20 or 21% of the homes. Keep the math simple. If it was 5 million homes, maybe that's 1 million homes a year purchased by investors. Vast majority of those being small investors. And the biggest institutions are buying a few thousand of those homes, but not tens of thousands of those homes, of those transactions that are happening. So when you really kind of look at least on a monthly basis. So if you look at it broken down that way, the percentage owned by the big institutions is actually quite small, but it can seem quite large because they're large funds or REITs with multi-billion-dollar kind of balance sheets, and it feels like they might be crowding out a lot of individual investors. I think the reality is there's been a shortage of inventory. Interest rates are quite low. People are looking for quality places to live, and there's just it's supply and demand, and there's just been a lot more demand than supply recently.
Yeah, I like the David and Goliath sort of headline piece you mentioned. That's what it feels like, and when you peel back the layers, it does take some of the bite off of the idea of Goliath coming in and swooping up everything.
And remember, David won, by the way.
That's true. Now we know how the story ends. We're good to go. Everything's good. But no, there's that agility that non-institutional investors have that is just hyper local, that larger institutions are just viewing things through a different prism, right? So I think that, that's a big piece. Kind of a separate but related topic, home affordability. Right, I think that's another headline, attention grabbing item. I guess we have to talk about consumer preferences a little bit. I'm 28 years old. I am a homeowner, but all of the talk about my generation as a millennial and the generation behind me is they want to rent, they want to rent, they want to rent. They absolutely don't want to be tied down to a mortgage, to one house and one address. You take that in play, you have home prices increasing rather drastically, and so much of that is how much of that's going to last. This HPA that we've had versus when everything's normalized and stabilized, how much of that's going to fall off. So certainly a loaded question with a million different angles of attack. But I guess to try to ask you one question, is the move to a renter nation, and there are other developed countries who are, significantly ahead of us in the percentage of renters versus homeowners. Yeah. Is that an inevitability? And is that your reading of the tea leaves too? Do you think that's the direction that we're heading?
I think that we could spend 3 days talking about this topic. It's
Yeah.
fascinating. Yeah, if you look at a lot of countries around the world, there is a lot more rentership than ownership. I still think that there is a desire for most people to own a home. But I think what's in the United States here, I think what's happening is
Mhm.
more people are renting longer, maybe 3 to 5 years longer versus buying. But I think ultimately, when you survey um, a lot of the renters, they eventually want to buy a home, the majority of them, but they're not necessarily in a hurry as long as they can have a place that they can live that's comfortable for them in the area they want to live in and offers them that flexibility, maybe to move without having to worry about selling something. So I do think that the younger the person, the more open they are to renting longer and maybe forever. Some people that don't need to own their home. I do think that there's something to separating where you live from where you own. That's quite a powerful concept, and that's one of the things that we're doing at Roofstock. So you, Dalton, could go onto our site and buy a house in Birmingham, Alabama for $125,000 and buy a home in Charlotte or Orlando or Phoenix or any of these other places,
Mhm.
get that home ownership exposure, have a tenant in there who's paying the rent and paying down your mortgage on that property, building equity and generating some cash flow on top of it generally. And then you could rent. And so at the end of the day, you're paying for your housing and you're renting and you're building equity in these rental properties. And so you're kind of separating where you live from where you own. Because if you lived in the Bay Area here and the average home price might be a billion, not quite a billion yet, 1.5 million, for a home in the Bay Area, or, at least $1 million, but probably $1.5 million.
Mhm.
That's beyond the reach of so many people, even have really good incomes. You just don't have the savings, or you don't want to just sweep out the corners and have everything, spend 50, 60% of your income servicing a mortgage. So that idea, I think, is powerful. And so I think the American dream, maybe, owning a home someday or multiple homes, but maybe it's where you don't live in many cases. A lot of cases it will be where you live.
Yeah.
But anyway, that's sort of my thoughts on it. In terms of affordability, you are seeing this interesting phenomenon where people, by choice, oftentimes paying even a little bit more to rent versus to own. So that does tell you
Mhm.
that for some people, they just value the flexibility. Maybe they're in a work from home construct right now and they don't know if it's enduring, but they'll say, "I'll rent this place for a year and let's see if it works out. And maybe I'll stay and rent long term. But if I know I'm going to be here, maybe I'll just buy something." So you definitely have some of that going on. Um, I do think you have interest rates being a very, very important part of affordability when it comes to mortgages. And so, and it gets to the question of, is the market overvalued today? And how do you define that? And John Burns, who's a researcher in the housing market, I call him an economist, and we were on a podcast last year, and he goes, "Don't call me an economist. It makes me sound like I'm, some ivory tower. I'm not an economist. I think he studied accounting actually, but he's got a great economic mind. And I was on a webinar with him a couple of weeks ago, listening to him, and his assessment was the markets that he covers, the single family rental markets, which is, I think about 30 of them they really dive into, was about 6% overvalued relative to the intrinsic value of the underlying property. And he had they've done a bunch of research about it, not 30%, not undervalued, but a little bit overvalued in terms of the way that they analyzed it. Um,
Mhm.
and that's probably within sort of, the margin of error. So that was an interesting way to think about it, because a lot of people might look at the market today and just say everything's just too overvalued. We're at new highs in most places. It's got to correct. But maybe, or maybe we've reached a new place where the growth is going to slow, but there's enough demand, as long as interest rates remain very low. And we could talk about, no one can really predict, but I don't see rates going up dramatically anytime soon. I think that they will trend up over time, but that sort of gets priced in. I think what you'll see is not big price drops. I don't think we are in a place where we're going to see a ton of foreclosures. I know there's been a lot of talk about, are we going to see a whole new foreclosure wave once the moratorium is lifted and all that kind of stuff. There's so much equity in homes today relative to the last financial crisis, when people were buying with 3% equity, or in some cases negative equity. I remember back when I was still at Zip Realty during the heyday, we had a partnership with a lender, and they were offering 105% loans, right? Because you finance your closing costs, your fees, some renovation costs, because things were, of course, just going to go up and to the right. So today, you've got a lot more lender discipline. The loans are being made with real equity in the homes, and homes have been appreciating double digit the last year or two in many markets. So there's all this embedded equity in these homes. So even if someone were to come up against some difficult circumstances, there's probably plenty of equity. So that home really shouldn't go to foreclosure. It should be sold into the open market. And there's still, even though inventory has crept up over recent weeks, it's still by historic standards low. And there's just so much demand for lots of reasons for housing for both homeowners and investors. So I think there's just so much support for the pricing in the housing market, and it's hard to add enough supply to get ahead of that demand, just with the constraints of building freestanding housing as opposed to, say, building apartments where you could go vertical. All those things, I think, bode to environmental constraints, land shortages, construction material costs, labor costs. All those things make it hard to just build individual homes at scale, and household formation keeps going. So for all those reasons, I tend to think prices are pretty sticky downward going forward, but I think you'll see in most places the rate of appreciation slowing.
Yeah, we're going to come back to the interest rate piece since you brought it up. So we're not going to let you off the hook without getting a reading of the tea leaves. But one piece too is the supply side that you mentioned, right? I saw earlier this morning some data, and depending on how you calculate it, there's either a 1.5 million to upwards of 5 million unit shortage of housing out there.
Yeah.
Right. And so that's going to be another pillar to help support home prices. I'm definitely in the camp that maybe there's going to be a natural low mid single digit stabilization, correction, whatever you want to call it. But yeah, it's certainly nothing like the Great Recession, where the housing, the assumptions of value, the quote unquote underwriting on the borrower side that was going on, you just don't have that today. The vast majority of that's stomped out. So you have generally good, qualified, creditworthy borrowers getting homes that they can and should be able to afford. And the housing machine works the way it should. And we just had a global pandemic in flight that knocked people off of job sites, right? You couldn't build in most locations for a number of months if you were lucky. Permitting is backed up all across the country. So that, I think just another pillar that's going to help support housing, and should be positive.
Yeah, for sure. I agree with all of those things. I think one of the interesting phenomena that's happened is this migration away from a lot of the bigger cities to secondary and tertiary markets. And it's been talked about pretty widely. We've certainly seen it with the activity on Roofstock, where people moving from a lot of these coastal markets into smaller metro areas. What I read about this week, and we're also seeing this also on our site, is now you're going to some of these secondary markets like a Nashville or a Charlotte, and you have boom towns that are developing outside of those cities. So now the Nashvilles and the Charlottes, for many have gotten too expensive. And so people are going 30 or 45 minutes away from those secondary cities. And you're seeing some of the fastest growth in these, ex-urban markets that are way out there. And
Yeah.
land is cheap and plentiful. People can work from home and maybe do that commute, a day or two a week if they need to go into their office. But all of a sudden, it opens up so many different areas. And I think you've seen a lot of the home builders taking advantage of that with communities that are further and further away from the traditional job centers. And so I do think there's some risk to that over time, depending on how this work from home shakes out and whether we end up with, more and more people gravitating to want to spend more and more time in the offices. I think some of the stuff that's being developed in a lot of these really peripheral areas may be a bit more challenged than some of the stuff that's a little bit closer in.
Yeah, that makes complete sense. I'm going to hold your feet to the fire in the next round here. So timely that you bring up interest rates, right? Not too long ago, Chairman Powell gave a good half-hour talk, and you had his headshot on one half of the screen. I was watching it on CNBC, and on the other side, you had kind of market tickers. Everything was green, everything was going up, and he had what the market clearly took as some pretty heavily positive signals about tapering and interest rates, really the separation of those two, that they're not going to move in lockstep together.
Mm-hmm.
What do you take away from, I guess, the most recent rundown from the Fed and what you're seeing on Roofstock? What's your reading of the tea leaves for the back part of this year in 2022?
Yeah, I think he's been handling this situation pretty adeptly. He's a savvy and obviously very smart person. I remember the last cycle that you mentioned, tapering. Back when I was at Starwood Waypoint, just as an aside, when we were looking to take that company public back in 2013, and we were not able to pull it off because back then was when the Fed announced some tapering back in the last cycle, and the REIT market dropped like 5 or 10% kind of overnight while we were exploring the waters in New York. So we're like, okay, we're not going public. we ended up partnering with Starwood Capital and then going public a year later. But the market reacted very negatively to the talk about tapering back then. But listen, we know it had to happen at some point here. I think people knowing it's going to be maybe decoupled from some, if rates were going to be going up at the same time as that, it could have a double whammy effect. So this is like, you're not just hitting the brakes and then putting on the emergency brake. You still have an ability to keep things moving. So my sense is rates will tend, and people have been saying this for years, they'll tend to trend up because they've been low. But I do think that they'll have to tend to trend up a little bit. I think we're going to want to make sure that we could stay ahead of inflation, right? Or at least not let inflation kind of run rampant. I tend to be not as concerned about it as some. I'm certainly not in Larry Summers' camp. I think Larry's a very smart guy. He's got his own views on inflation, and I love listening to his arguments, but I don't necessarily find all of them persuasive. I think that there's some other offsetting factors that will kind of keep inflation in line. But if it does rear its head, I think you will see that could be a catalyst for raising some rates and trying to like slow things down a little bit. But for the most part, I think it's hard to prognosticate, but it feels like this recession that we had, although it was very significant, was very short-lived. It's the shortest recession we've had in recent memory. But it definitely was hit a bit of a reset button, and we've been able to grow from there because we were really kind of toward the tail end of our cycle anyway, and there had to be some sort of correction at some point soon. The question now is, for the real estate market, was that the correction that we needed, and now we're on another 10-year run? Or is this just like a little mini blip, and we're still just kind of late in the cycle, but we kind of maybe went back a year or two? And that's what nobody yet knows. And if I knew the
There,
answer to that, Dalton, I wouldn't be doing what I'm doing right now. I'd be doing something else. I don't know.
no, that's fair. Dare you venture a guess or an early wager at one way or the other, or just too deep in theory to even attempt?
I think it depends on the asset class. So
Okay.
for houses, for example, didn't correct, right?
Yeah.
What we really saw was transaction volume screeched to a halt. Then everybody said, "Oh, geez, I need a house," and then houses have gone up in value. So you haven't seen any sort of reset. You saw a quick slowdown, but things like offices, for example, or retail, um, hotels, you saw significant corrections in those asset classes, and so they're kind of coming off a lot of difficulties, and to varying degrees still working through them. So I think for a lot of them, that's probably a reset, and they're kind of going through rebuilding value. So I think with each real estate kind of vertical, you have to kind of look at how they reacted during COVID. Another one that performed quite well. So I think you have two asset classes that performed really well during COVID: single family rentals, kind of housing broadly,
Hmm.
and warehouses, kind of this like warehouse distribution space that really benefited from, online delivery. All the Amazon distribution centers and all of the e-commerce exploded during COVID. And so you've just seen that kind of the warehouse and distribution, demand go off the charts. And so, but really those are kind of the only two that performed really well. The other ones, for the most part, were challenged and are still sort of working their way back.
Yeah, you jogged my mind about short-term rentals, right?
Yeah.
So something that the last couple years, I think in my day job on the private lending side of the fence, something that we've heard more and more of from investors, the need and want for financing on it. Previously, you go back,
Yes.
3 years or so, it was a very different conversation that we would have compared to, just before COVID, whenever I think a lot of folks were starting to get more comfortable with it on the lending side, finding
Mm-hmm.
some kind of hybrid underwrite between, we're not going to take your $6,000 a month that you make during the summer and work into this witch's brew number that, this is what the rent is. We're also understanding that getting a standard appraisal and a rent estimate that says this is going to cash flow, a gross rent of $800 a month. That's also probably not the right way to do it. Short-term rentals, that's something that you saw financing dry up for. And one of the slower things to come back on the financing side of the fence was an appetite for short-term rentals. What's your
Mm-hmm.
take on kind of the long-term lease rental versus short-term rental?
It's funny. I wish you were on my call an hour ago. I was just on with a bunch of my team, and we were talking about the short-term rental market. It's something a lot of our customers have been asking about. In
Mm-hmm.
fact, we're going to stand up a pilot soon to allow people to underwrite homes on a short-term rental investment basis as well as a long-term rental, really just based on tons of interest from our clients. Um, what came up on the call was, will lenders lend against the cash flows from the short-term rentals? Because a lot of them are generating, call it 8 to 12% net yields on an annual basis. And when you look at long-term rentals, they might be generating a 5% or 6% net yield, in some cases less. Now it's a longer term lease, arguably more predictable, but there's an awful lot of room there on the short term side, and increasingly predictable. And so the question is, if you've got two homes, and one of them can, and that's, let's say that same home would appraise for $300,000 to an owner occupant, but you could generate an 8% net yield on it, or a 10% net yield on it, investors will buy that yield down eventually, and that they might be willing to pay $350,000 for that house or $400,000 for that house. So it actually is worth more with that short-term rental overlay. But until appraisals reflect that income, they're not worth more, as you
Right.
can't borrow more. And unless it's a cash buyer who doesn't care about how much they can borrow, or they're just borrowing a much lower LTV on those homes. And so I do think there's an opportunity for lenders, if there could be innovative lenders out there who would get ahead of it and maybe even have some creative ways of having the debt service more track the income on a seasonal basis, or giving people some credit for that. I think they could get an enormous amount of market share. I think a lot of people are looking for that financing, because it's really, we get frustrated even in the single family rental space. Sometimes we have that same phenomenon where investors are willing to pay more for a home for its income component than it will appraise for. And
Right.
and that happens more often at the lower end of the market, where someone's buying a high yield and the appraisal comes back, and maybe it's a $70,000 house and the appraisal comes in at 62.5, and you're like, wait a second, this is a great house and a great yield in this market, but the comps are all over the board. Some of them are distressed. They're not necessarily rentals. And so the appraisal world is a little bit, I don't want to say caught in the dark ages, but it hasn't caught up yet to the way investors are looking at some of these opportunities.
Yeah, definitely exciting waters to be charted there. Gary, Roofstock is, I'm sure, no shortage of data, right? Numbers across the country, just because of your reach. What did we miss? What's hidden away in the data secret vault? What's top of mind?
Well, Dalton, if I told you our secrets, they wouldn't be secrets. So that's that's not. I'm not going to divulge anything proprietary. We do have a lot of data. So we have mapped all 90 million homes in the U.S. So it's called our rental genome project. So we mapped every home. We know the characteristics of those homes, who owns them, if it's a rental or not, what the rent is, what we think it's worth, how to contact these folks. And so you could literally fly over the whole country and zoom into any city, any neighborhood, any house. And then, and we've built this out over several years, and we're tracking a lot of information and data around these homes and these neighborhoods. We've built some interesting technology to try to get better at automated valuations, because right now you can sort of go to Zillow and get a Zestimate, which is it's a proxy for the value of the home, but it's not. We all know it's not perfect, but it's it's something to start from. Everyone's got these algorithms. We've built something that we think is even better than what everyone's been doing, based on the exact location of the home and how far it is from different things that either could detract or increase the value of the home. So, for example, and you could see this from a lot of public information, if there's power lines running through the backyard, it's a negative. And we could over time figure out how much homes with power lines sell for less than homes that don't. If it's across the street from a park, that's a positive. And the same thing is if it's 2 blocks from a school, that tends to be a positive. If it's across the street from a school, it tends to be a negative oftentimes because of all the noise. And so just capturing all this data and running it through and letting our data scientists go nuts, finding all those relationships. So we could start with what might be akin to like a Zillow or something like that, and then it gets adjusted based on the very specific attributes of that location. So then you start to marry that with our database on the homes themselves and the physical characteristics of those homes and the ages. You start to think about over time, as people get more and more smart technology in their homes, being able to monitor a lot of that stuff. There's wearables data that we're looking at now that you could get access to see where people are going as a proxy for where the growth might be going, where people are jogging versus not jogging. There's countless things like that when you just have a bunch of data scientists running around looking for patterns and just running a bunch of crazy things. But that's what we're trying to do is sort of kind of get steeped in that data and look for signal out of all that noise.
We brought it full circle. We talked about how relatively young Roofstock is, 6 years old, and I was thoroughly impressed by the numbers I was seeing. Y'all are going to do $2 billion, and now it all makes complete sense. You just you bring on a bunch of data scientists, just algorithms, numbers. Go make it happen. So this all makes sense for me now.
And it's all about using that to kind of demystify everything and develop insights, and then help provide a solution for people. So it's easy to get too caught up in the numbers and just kind of spin our wheels, but it's all in service of trying to build a marketplace that's got a lot of transparency and allow people to make their own decisions. What's interesting about what I love about marketplaces is, by definition, there's a buyer and a seller who both feel that it's a fair price for something to trade, right? I feel like this is fair. And people look at the same property and have totally different read as to whether that meets their criteria or not, because people have different things that are important to them. And so the more people we could get to engage on our platform, the more liquid it will be, the more we could continue to drive down costs, and the more we could squeeze out friction and costs, the better investors could do, because there's more left. There's more meat on the bone for the investors. And as long as investors are doing well, we'll attract more activity to our site and create more liquidity. So that's what we're really trying to build, is the most liquid market in real estate.
No, everything you just walked through, true value add, right? Just adding a deeper level of transparency. Everyone is empowered with more information about what's the true value of this asset, right? The things you mentioned, power lines in the backyard. Is it in a great school district versus literally being across the street from a great school in a great school district? All those things that sometimes are tough to quantify, and you all are doing it on arguably one of the largest scales in the country. So it's highly impressive what you and the team are doing. Gary, I cannot thank you enough. Roofstock.com, right? That's where everybody needs to go. Take a look, poke around, go buy some property. Let's keep it going. Gary, thank you so much for joining. I really enjoyed chatting with you.
Great. Always good talking to you, Dalton. Thanks.
For sure.